Happy New Year, investors. We've made it to 2023. I hope you are all awake and ready to rock and roll because we have a lot to unpack in today's video. But for those of you who are new here, I'm Ari. I'm here as a dividend investor, strictly talking about value in dividend stocks, which I already know what you're thinking. What a great channel to subscribe to for 2023. No, in all seriousness, investors, I want to get to it today with a little portfolio update before we talk about our economic backdrop, and then I want to dish out what you probably came here for, the 7 dividend stocks I am telling you you should be watching right now before we really ebb and flow our way into 2023. Before we get going, tap on that thumbs up button, and if you're not already subscribed to the channel, join me by subscribing now. With all of that said, let's dive right in. We've made it not only to a new month, but a new year. Now, normally I do a video breaking down my December dividends and then run you through how much I earned in dividend income throughout all of 2022. But stay tuned, that will be next week's video because I wanted to do another video today for all of you regarding stocks you can buy now or should be at least looking into given the opportunity to snag them at a discount. As for my personal account, we made it into the new year above $100,000 with my account sitting at $101,787.81. As for my macro overview, I think it's safe to say that we ended 2022 in fear, and that fear will have us ebbing and flowing weeks into months into the new year. Now, you should remain aware that we will have CPI data coming out in the coming weeks, and the Federal Reserve will once again be the center stage come the end of January, which will be market moving events that we should be aware of. Now, ultimately, I foresee a hard-hitting recession coming our way about 6 months into the new year and think every investor should be preparing for one. Of course, best case, by some divine miracle, we completely avoid a recession and you'll have invested into quality companies. Now, it is just better to be prepared for the worst case scenario. After all, failing to prepare is just preparing to fail. So then what do we do? How do we prepare? Simple. 2023 is a year to invest into companies that have great leadership, strong brand names, and are ultimately well capitalized, which leads me to the very first dividend stock of the day that I'm actually most excited about, given it doubles as a growth stock as well, and it's my largest position aside from my index funds within my portfolio. Now, the stock is Apple, ticker symbol AAPL, and I do want to share that whether it is Apple or Microsoft at this time, I think we are looking at some bargain deals. But guys, I'm personally an Apple guy, so let's explore this opportunity. As of right now, Apple is down nearly 30% year to date, trading for around $126 per share. Now, as Apple has been on the descent, I have been dollar cost averaging into Apple, whereas I bought 5 shares the other week at $132 and another handful of shares at $128 per share. But I'm going to, in fair disclosure, share that I think Apple may continue to slide, and I personally just want to begin dollar cost averaging in as a just in case. Ultimately, I own 130 shares worth of this $2+ trillion market capitalized tech leader. Now, in terms of Apple's current standing amidst all of our market conditions, I think we have 2 major pain factors, which are a potential recession, which will make consumers think twice about spending on luxury goods, aka $1,000 new phones, and on the other end, Apple's supply chain woes are just likely to continue well into 2023. However, think longer term, and I see Apple continuing to pave the path forward into an AR future, which their headsets, as I keep sharing, are going to be very disruptive. On top of that, we have Apple Car, which I'm confident will be a massive game changer. So I remain long on Apple and will pay the premium, as I never foresee their PE ratio falling below 20, to which it's currently hovering around 21.3. Now, I'm not the only one here taking advantage of Apple. We have smart money taking full advantage of the world's most valuable company at this discount. Now, analysts see Apple making an eventual comeback with over 43% worth of upside. It's coming to a stock share price of $180.95 per share. Until Apple's on that comeback, shareholders will reap the reward of Apple's share buyback program in addition to their dividend, to which the yield was recently increased to 0.7%. Now, while we're on the Apple and tech topic of conversation, one of the largest issues humanity has literally been facing over the last few years has been our disrupted supply chains, but more specifically a lack of semiconductors. Therefore, I want to once again dive into Taiwan Semi, that's ticker symbol TSM. And investors, this time, I don't want to hear it from any of you. The last I spoke about Taiwan Semi, I got a lot of heat, with some haters sharing,
"Why would I choose Taiwan Semi out of all the other semiconductor plays?"
Then what do you know, Warren Buffett's 13F filing is made public, and Apple partners with them too. So now, Taiwan Semi did see a run-up after the news came about, but it is ultimately still down over 41% on the year, and as of this moment, their PE ratio isn't too shabby at 12.7, which is why we likely see hedge funds continuing to pour money into Taiwan Semi, and personally, I think they're setting themselves up well for the next decade with factory upgrades right here at home in the United States. But of course, let's see what our analysts are sharing, because I'm not the only optimistic Taiwan Semi fan. We can see analysts are forecasting over 34% worth of upside, bringing the share price up to $98 per share. This is not to say that other chip players aren't solid investments, but heck, I'm here and pretty confident that this $379 billion market capitalized semiconductor investment will fare us well, and until it rebounds, we can collect on their 1.97% dividend yield. As for our third dividend stock, we'll segue from chips to chops with Tyson Foods, ticker symbol TSN. Again, another stock that I mentioned relatively recently, but this is the world's second largest processor of chicken, beef, and pork, not to mention the largest exporter of meats out of the United States. And Tyson's successes have led to a $21.47 billion market capitalization, but they've been hit hard with their share price plummeting over the last few quarters because of misses on their earnings reports, bringing their share price down to $61.19 per share. It's a little over 26% worth of a decline since the beginning of the year. However, I'm rather optimistic about Tyson, not necessarily because they have the reputation they have and their global standing in comparison to other meat processors, but more so because they're taking steps to ensure profitability, like trimming corporate fat in a consolidation plan. And should a recession hit, no one's going to stop buying meat altogether. They're likely to just look for cheaper options, which is where Tyson Foods comes in. Now, we do see hedge funds beginning to invest into Tyson, but looking to our analyst, I get even more excited in seeing over 22% worth of upside as expected, with the share price reaching $75 per share, and there is no better time to invest than right now with that PE at a low of 6.8. Now, until Tyson is back on that come up, we can beef up our returns with their dividends, given that dividend yield is coming in at 3.03%. Coming up on our fourth dividend stock, let's talk about the one, the only JP Morgan Chase, ticker symbol JPM, which is the largest bank within the United States with over $2.87 trillion on their balance sheet, and just a powerhouse when it comes to a global bank, with their international operations continuously expanding, allowing for that market capitalization to peak above $388.53 billion. Now, with interest rates rising and remaining elevated likely for another 12 plus months, financial sector investments, particularly those which lend money, will likely perform well, and should a recession hit, this is not another 2008 situation. Banks have all passed stress tests, and JP Morgan just remains a fortress. So why not take full advantage of this dividend opportunity, given it's down over 15% on the year, trading for $132.46 per share, with that PE ratio still rather low at 11.1. Heck, smart money has been doing exactly that, as we see plenty of hedge funds capitalizing on this opportunity. And as for analysts, it looks like it may not be as much upside as some of the other stocks mentioned, but perhaps more reliable here, with their share price forecasted to hit $143.15 per share, roughly 8% worth of upside. And of course, there's also that enjoyable dividend, with that yield coming in at 3.05%. Next up, and never before mentioned dividend stock on my channel, we have NetApp, ticker symbol NTAP, which I recently found after doing some digging for under the radar flying dividend gems. As for NetApp, it's a hybrid cloud data services and data management company that was founded back in 1992 and has since amassed a sizable $12.54 billion market capitalization. Yet amidst all of the volatility from our economic conditions and companies really just cutting costs, NetApp has felt the economic pinch, as depicted in their share price, at just $58.18, which is down by over 35% from the beginning of the year. Now, their PE ratio is at 8.9, which is far below many of their competitors at this time. What a steal! And as for analysts, there is a forecasted target share price of $78.94 per share. It's presenting 35% worth of upside. That also comes with a solid dividend yield coming in at 3.39%. But if such an investment is a bit too risky for you, or any of these investments are not at a level of safety you're looking for, say if you're nearing retirement, I'm positive that Verizon, ticker symbol VZ, is now at a ripe evaluation to buy into and hold for 2023, should it get as ugly as what we're painting it out to be. Now, because I'm sure most of you, if not all of you, are familiar with Verizon, I'm going to get right to sharing that its stock has been sliding quarter after quarter with a current share price at just $38.81 per share. Investors, that is over 21% for a company that is hardly ever rocked by market volatility. I mean, really, for the most part, this $162 billion market capitalized telecom leader trades sideways, which is why I have mostly disagreed with dividend investors on this one when they were sharing to buy this months ago. I often stated an investment in Verizon would really require a fantastic buy-in price, which is, well, now, especially with a PE ratio coming in at 8.4. And what I like seeing when it comes to Verizon is the growth, which you seem to only get when it rebounds from large sell-offs. So here we are with analysts seeing over 21% worth of upside with Verizon, coming up to $47.11 per share. Now, smart money has really been loading up on Verizon. As for dividend investors, we just reap those benefits of a whopping 6.7% dividend yield. And finally, investors, our last dividend stock is another never before mentioned on this channel, but it's one heck of an opportunity with a lot of insider and hedge fund activity. Let's dive into Enterprise Product Partners, ticker symbol EPD. Now, if you haven't heard of it, don't sweat it. I only recently discovered it, but Enterprise Products is a midstream natural gas and crude oil pipeline company, aka a provider of energy services to producers and consumers of natural gas, with their pipeline network stretching across more than 50,000 miles. Now, initially it was founded back in 1968 and just continuing to dominate the sector with a current market capitalization of $51.69 billion. As for its performance on the year, Enterprise Partners is trading for $23.76 per share, which is actually up by 13%, largely because of a resilient revenue stream, conservative balance sheet, and just strict capital allocation guidelines. But what is more is that PE ratio is at 10.3, and analyst forecasts are coming up to $32 per share, which is over 34% worth of upside. Personally, I think we have a lot of investors investing into the Exxons and Chevrons, but overlooking this one. And if you're looking for a rock solid indicator for an investment, it's when a company's insiders are scoring more shares of their own company, which is what we're seeing here with Enterprise Partners. And that is just in addition to hedge funds pouring more capital into the investment. Now, here's the big warning. Enterprise is structured as a master limited partnership, which essentially means that tax liability is passed on to all of us, the investors, but still it may be worth your attention given that dividend yield is sitting at 7.8%. And that's a wrap. From Apple to Taiwan Semi, Tyson, JP Morgan, NetApp, Verizon, and Enterprise Partnership. Those are the additional 7 dividend stocks I feel you shouldn't let go without researching as we enter 2023. But please let me know your thoughts on these stocks, or if you feel that you have better ones that we should all be aware of, comment away down in the comments below. Now, investors, I am not a financial advisor, so just remember to always do your own due diligence. And on the other hand, I am a creator here on YouTube, so tap on that thumbs up button and join me on the journey before the year is really underway by simply subscribing. Guys, it's 100% free, so zero excuses, except for the one that you're probably telling yourself right now in this moment. Now, investors, with that said, I will see you all in the next video.